Welcome, everybody, to Charts and Chats with me, Gordon Scott, and with you. If you're here and you can hear me, then I'm glad about that. And I think you're going to be glad about that too in just a couple of seconds, because what I'm about to show you is a significant opportunity to trade and profit. I really believe that within about 6 weeks period of time, you will be prepared for and able to take advantage of an unusual trading opportunity, one that will come around probably not very often, not much more often than once in a year, to be sure, but maybe even once in 5 or 6 years going forward. We'll see. But this is really going to be cool because although I'm calling this countdown to Doomsday, for you it should be something a lot happier sounding, because you're going to be prepared for it and you're going to have an idea of what you can do to profit from it. So I've got some charts that I want to show you that will explain all this, and then we'll chat about it. Let me share my screen here and we'll get an idea of what's going on with the markets right now to begin with. And let's see if I can do this properly. Okay. What we're looking at here is a comparison between the Nasdaq and the Aussie Yen, just so that we can see how things have shaped up in the past 72 hours. And there's some interesting things going on here. Look at how the Nasdaq moved from its close last Thursday. Of course, the US markets were closed because of Good Friday weekend, and I hope you all had a great Easter weekend, by the way. The price movement drifted higher from Thursday through Friday. These are the Nasdaq futures, so they're trading even though the U.S. markets are closed, and so the fact that they're drifting higher while the U.S. markets officially are closed is interesting. That's certainly a bullish indication. But then, right here, just in the past 24 hours, what we see is it opens to a fair degree of fluctuation, comes right back, sits down on where it closed, hung around there, and then came up to try to make a new high. And so this, I've got my, there we go. So now it's sitting around here, having a hard time trying to break the fluctuation high that it got out of. All right. Now, if we compare that to the yen, the Aussie yen, we see clear back here. This is the Thursday activity, and right in there is where the close of the U.S. markets occurred. And we see also that it drifted for a while, but notice how it got weaker. It came down lower than where it had closed, or where the U.S. Market had closed. And although it's drifted back up, it still has not hit a new high. So generally speaking, we're seeing relative weakness in the Aussie yen compared to the Nasdaq 100. And right here, again, look at the opening, this big fluctuation which occurred also. And that's part of, the sort of extended trading break, and, the effect of that, people coming in and making some adjustment. A lot of uncertainty there. You don't usually see this kind of thing. A lot of uncertainty coming out of the extended break. And the good news for all people that like to buy and expect things to go higher, for the people who like to trade long, the good news is that the Aussie yen's low was not breached like the Nasdaq's was. But the bad news is that the high has not been exceeded. So what we've got here are some very tepid, very uncertain bullish moves. Now, the S&P 500 looks a good bit stronger, but the Nasdaq and the Aussie yen, those are the two that are more highly correlated to each other. And the reason I'm focusing on these is just to say, to start the week, we've got this show of nervousness, little cautiously bullish, but some nervousness. And that theme is going to persist throughout this week and the next, and it's going to be less and less optimistic and more nervous over the next 6 weeks. That's my prediction. Why would I make such a prediction? Why would I call it Doomsday? Why would I call May 14th specifically Doomsday? Well, I don't have a guest this week on purpose because I specifically want to go through this scenario very carefully and show you years and years of looking at this. When I discovered this effect was in 2012, the summer of 2012, and I've been watching it ever since then, and found that statistically it just keeps reinforcing itself. Now, like any seasonal or timely indication, there's no nothing is 100%, and there's always nuance and variance because the market is people. The market is just people making and fully account for what one person's going to decide compared to another. And we're talking about the cross currents of millions of people making decisions simultaneously. And so things happen a good bit randomly all the time. This is why technical analysis patterns and price patterns don't play out the same every time. The market is not a machine. The market is a collection of people. It's so many people, however, that a great deal of randomness gets injected. But it isn't fully random all the time. There are times where you can predict, and this is probably the most persistent and predictable thing I have found in the markets. And I'm going to be explaining to you why this is what I believe is such a highly predictive model and method for looking at price action in the markets. To explain this best, I'm going to go back in time to a chart of the S&P 500 in 2009. So I'm going to use mostly the S&P 500 to track this, but I've actually done research now just in the past year. I mean, when COVID came around, everybody had a lot more time on their hands. And what I did with this was dig into what was even my favorite of this 56-week pattern, I call it. It probably should call it the 270 bar pattern or something like that. But in any event, I dug into this further and began applying this pattern to many other markets. And if we get time, I'll show that to you today. And if not, I will show that to you at a future time. Let me get my chat window up. Yes. So Roy is asking, hi, Gordon, any logical reason why after 56 weeks, lots of people tend to sell at least after at least 7% gains in the 20-day period? There absolutely is a logical reason. I'm so glad you teed up that question. No, I did not pay Roy to ask that question because that is the key question. Is there some sort of logical reason? Roy's been around. He's heard me say this before. 56 weeks happens and all of a sudden selling happens, but this only occurs after a time when there's 7% gains. So why should that matter? Okay, absolutely. And the short answer, because you're probably itching for that, is taxes. Yeah, that's the short answer, taxes. There's this thing called the long-term capital gains tax, and it differs from the ordinary tax rate. Usually it's about half. Now, in fact, Joe Biden might make a change to that soon, or the Biden administration might make a change to that soon. And so it'll be interesting to see whether or not this persists. But for now, it's still in place. Basically, what happens is there is a tax benefit to selling after 1 year of holding. So if you're a high net worth individual, or you're a mutual fund that's got a lot of monies that's subject to tax rules, then what happens is if you have made gains over a period of time, as long as that period of time is slightly longer, as in 1 day or more, longer than 1 year, then the amount of tax you pay is about half of the marginal rate compared to the day before. So with that strong incentive, anybody that gets close to that, almost one day. If you're 11 months, as an example, you're going to hold off selling until you just go another month forward. Why wouldn't you? I mean, it's like sell now and pay 40, 30, 20 something percent, or hold on for one more month and pay half as much of that on taxes. Now, taxes aren't everything, but if you're talking about 20% versus 10% or 30% versus 15%, that's very significant to your overall performance. So it's really strong incentive to not sell until that length of time. And 20 days, why is 20 days important? Well, I went back through the charts and looked at all these things to try to figure out what time periods seem to matter statistically the most. And this is what I came up with. In fact, let me take you to the beginning moment where I discovered this. I was in 2012, but I was looking back from there. And in 2012, I had just read an article about the flash crash. Now, flash crash was this thing that happened in 2010. And so I've got the chart here. You can see the big downward move. Whoops. The big downward move that happened in 2008 and into 2009. And terrible times. Financial markets were in crisis. Maybe the whole financial system was going to melt down. People were worried. And then all of a sudden we get this massive rebound. And then one day, seemingly out of nowhere, the Dow drops 1,000 points inside of an hour or two. And that's pretty, amazingly scary for, well, let's see, I've got a thing running, which might be degrading my internet real quick here. I wonder if I can, no, we're just gonna have to go on. We'll have to live with it. Occasionally we'll get these little blips. No, it's not me being throttled or at least I hope not. Oh, wow. Black helicopters on the way. No, it's not that. So what happened is that in 2009, look how fast and how rapidly the market moved up just in a 20-day period. Okay, so you go from the lows of March 9th to 1 month later, about April 10th or so. That's 20 days. And this move was something like 14%. Let's see if I can get the time and date and price range drawn in there for you. Okay, so from that day going forward to about April 20th. There we go. And I gotta put on the no. Sorry. I want to make that little date and price range show its time and yeah, the label. That's what I need. Oh, the label. I actually want that to be black. And let's have the label background be green, light green. There we go. Whatever. Okay, that's not working. Why isn't the label showing up? Background label. Oh, because it's fully transparent. There we go. All right. So that's 31 bars. Let's back it off to 20 bars. 20 bars is 20 trading days, which is about a month. Okay, and as I said, I did a back test on this and let the system optimize for what periods were most statistically significant. And what I came up with was that I have to go 1 month, and then from the end of where 1 month, so 1 month from the low, whatever apparent market low there was, and then if that turns out to be higher than 7%. So why 7%? Well, okay. I'll come back to that one. But basically what I noticed was this flash crash happened, and in 2012, I'm looking back and I'm thinking, do people need to be prepared for a flash crash to happen again? 1,000 points down in the Dow in a single day, just a hair shy of 10%. They were almost about to hit a circuit breaker, which is very significant because before the circuit breaker could get hit, computer programs started running in and buying and buoyed up the index, which is why all of a sudden, although it crashed down, it came right back up in the same day. And notice then that it didn't stay there. After 3 or 4 days, it went right back down to a new low and sort of bottomed out and so forth. So a lot of people tried to say, well, it was computers. Computers did that, or there was a single firm, a sort of they're not exactly boutique. They're not one of the biggest, but they're pretty big. They walked in with a something like 12,000 contract sell order in the futures market, sell the S&P 500 futures. And I have friends that worked at this firm, and this firm wasn't known for being technologically savvy or the leading edge of anything in terms of forecasts and recognition. So to me, I understood, look, if that firm walked onto the trading floor with 12,000 cars, as they used to call it on the futures floor, 12,000 contracts to sell short, which is absurd. Nobody who actually wants to make money should take that size of an order to the floor. So why would they do that? Well, because they didn't have sophisticated computer algorithms to try to dribble it out and sell it. They do now, but in 2009, that particular firm did not. And so they weren't idiots. They may not have been, the best and leading and technological savvy kind of group, but they weren't idiots. Why would they walk onto the floor with 12,000 contracts to sell? Well, because they had to, because that's what their customers told them to do. Because that's, after all, we're talking about a brokerage firm who makes money not because they're trying to pick the directions, but because they're trying to manage other people's money. And when other people say, get me out, sell me now, then they do. Now, today, if you're a high net worth individual, you have, say, 20 or $30 million investing position somewhere in the stock market, and you run to your broker in a panic, you say, get me out now. Not so much your broker, but your money manager, asset manager. Well, the first thing they will do is try and talk you out of panic selling. So, well, wait a second, we can get you out. We can get you out right now if you want, but you'll take a haircut. What you really need is just give us a few hours. I mean, maybe within even a day, we can get this done. We can liquidate all your positions, but we got to make sure that you don't have any insider rules. We got to make sure that we don't sell you out of something that you're an insider on because you're a board member or whatever. They're going to take care of all of that, and they're going to calmer heads prevail type thing. That's the first thing they would do. Well, back in the day, if Waddell and Reed, that was the company that brought the order, if they had clients that were trying to tell them, sell me out, well, that they would have tried to talk them out of it. So the fact that they walked onto the floor to try to sell all that stuff in the middle of the flash crash, that eventually touched off the flash crash, then why did they do it? Because people were telling them, sell us now. And it probably wasn't individuals, right? If you think about it, it was probably a bunch of family offices or funds of mutual funds, and ETFs were going pretty big. They're not as big as they are now, but they were still going pretty big in 2009. So there was a lot of orders that just got generated and thrown at them. Why did those orders all of a sudden come in all at once? All right. Now, if you look back and you read through what are the reasons for the flash crash, there was an article, and this is what I had started reading in 2012, that said, oh, and there was this whale in London, this big computer guy or computer trader who put in massive orders. But that has since been debunked. That no, he might have done some selling, but it wasn't a big thing. Other people have pointed to the Waddell and Reed order and said that really is what got things started that day. But it wasn't computer failure. which was the knee-jerk reaction. Everybody wanted to say computer failure, ruined the markets, and markets were poor. Hey, they said that clear back in 1987, which in 1987 that might have been plausible. You got a bunch of IBM PCs sitting around the marketplace, and not terribly sophisticated program. In 2009, that's just no. Now, I watched orders in the Thinkorswim system in 2007. And in 2007, there was too many errors, too many data errors created by too many computer orders coming in all at once. And they did something about that. They upgraded it. They upgraded their computer systems, not just them, the clearinghouses, all sorts of them, all the way through 2009. There were no data errors. Now, there's some craziness, like on the very worst day, the day that Lehman Brothers failed back here in 2008. There was some pricing craziness. Spreads got really wide, but there were no errors. So it's absurd to think that we went through all that huge downward move and this crazy panic selling and a much higher volume that occurred on these days than occurred on the flash crash. And then to come along and say, oh, it was computers made a mess up on this day because none of these days were crazier. I mean, that's not the case. So I went looking at that and tried to think, what was the underlying cause? About that same time, I was walking down the halls of a major university. I was going to talk to the professor who was the head of the investment club for that university. And they have a strong finance program and a very strong accounting program. And I went and met this professor in the hall and said, hey, I understand you're in charge of the student investment club. I was wondering if I could line up a speaker for you guys because we have some really interesting insights that your people might want to know about. And then we started up a conversation over that. And he was telling me the rules that he uses to guide his students. I said, oh yeah, you have rules. That's great. Now this is a fundamental shop. Most of these people were all about, most of the professors in this university were all about looking at various ratios and recognizing how healthy, how strong, and how long lasting a business was and what its prospects were likely to be. So technicals, poo. At least that's what they said. Although when they showed me their charts and their spreadsheets had 300 different ratios, and then down at the bottom they had the RSI. I'm like, what are you doing with that? If you're all about fundamentals, why do you care about the relative strength index technical indicators? Says, we do use a little bit of timing. I'm like, okay. So you actually care about timing. I said, do you have an exit rule? He said, yes, we actually have an exit rule. I said, okay. He said, well, we wouldn't sell within a year. So we have an exit rule, but it only applies after day 366 in whatever investment we've put on. It's 366. I was like, you're really, the 1 year long term. He says, yeah, long term capital gains. It's free money. So it's just crazy not to wait. And I thought, this is a finance professor who's been here at this university a long time. And he's teaching lots of guys that are going out and working in funds and hedge funds and so forth. And he's teaching them this. I wonder if this is just this place. Well, I went around and I talked to 2 or 3 other people in other universities in disparate areas of the United States. And then over the following months, I talked to money managers. This is guys at Wellington, guys at Merrill Lynch, guys at Fidelity, people that are in charge of managing billions and in some cases, Fidelity, trillions of dollars under portfolio management. And they all said the same thing. 1 year mattered. They wouldn't sell inside of a year if they didn't have to. So there's plenty of times where they do, of course, but they try to avoid that. So they care about that 1 year time frame. And I realized it's not just academia, it's practice. It's been going on for a long time and it's persisting and it's still going on. These people care about this 1 year thing. I thought, well, if they care about a 1 year thing, where was 1 year back from the flash crash? What was going on? And when I started asking that question, that's when I found this. And I looked back and saw, wow, there's this huge run up that happens here, and there's this huge sell off that happens there. Really? Is that a thing? Does it keep going this way? So this is the one where I saw it, and I went back, I looked over the charts for years in both directions, and I found, I tried to map out all of these. And like I said, I ran a back test on it. And what the back test showed was that the periods of times that were most optimized were 1 month at the beginning. So in other words, it takes a month of, see, it's not just one person who says, well, it's the low, I'm going to buy, right? You got to find enough people that buy. And then for a month, they're all sort of saying, well, it seems to be going up, or maybe you're getting out. Maybe you're, you're short and you're buying to cover, but whatever. A month of that has to happen. And so you get a whole bunch of players that sort of, create this collective look here, this critical mass. That's the words I'm after. And once you get a critical mass of buyers at some degree, now you have a whole bunch of people that bought at the same time that have the potential to, if they sell at the same time, move the index. Okay. So as I say, I did this back test with a couple of different software packages. I've run this on NinjaTrader, and I run this on now I can't remember the name of the Optima is one that I used later, but even before, back at this time. Gosh, that name's going to come to me. So anyway, 3 different software packages that are designed for Metastock. That's it, Metastock. 3 different software packages designed for doing this kind of back test. And then most recently, during COVID and the past year, I actually downloaded S&P 500 data, SPX and SPY both, from finance.yahoo.com. So if you think that their data is clean enough, right? Any data source is going to have some degree of errors, but Finance Yahoo's is clean enough data, I assumed. And the biggest important part of this, I did this manually so that anybody else could replicate my research and find it out for themselves. If you go to finance.yahoo.com and you pull up the S&P 500 in charts and you look, they have historical data, and then you can do this historical data, and then they have a download button. You can actually download all this data for yourself. And so I actually did that. Then I went into my Excel spreadsheets and I just simply programmed, or not programmed, but did formulas for columns that did a 20-day moving average and 20 days back, what's the change, and so I did everything I needed to do to come up with, okay, what is starting on this day and then going 56 weeks forward, or in other words, 270 bars forward. What is the change, the performance change? And so how much has the index increased or decreased after 270 days, right? So I did that sort of thing. And then I just did an average of over the years, and I did this with the S&P 500, SPX, going all the way back to 1928, because that's when the data goes back to. And I found that if you do every single day and you track every single day, because I want to know what the baseline was, what is the average, you get about a 7% performance increase at the end of the year. So after a year's, after 270 bars or so, you get 7%. And it doesn't matter which day you start with. That's the average of almost 100 years of data. You get 7% rise in a year's period of time. Okay. So, but what happens if you start looking at those periods where just within 20 days, you have an unusually high gain or unusually low gain? And what I found was that it didn't make any difference until you start getting to the top 3% and the bottom 3%. Then all of a sudden, it was 7%, just like walking up a ramp, very smooth line, 100 years of data averaged, right? That's what any given day in the markets look like. So from a big perspective, you lose all the up and down. But if you just go the top 3%, that is, if after the first 20 days you've moved a certain percentage, whatever percentage it was, then how much up or down begins to change things. So if you take the top 3%, it turns out that that 3% level is 7%. So this is where it comes from, Roy. The 7% amount is anything above that is the top 3% of all data sets. But there's something else, right? Is what we just mentioned. The markets are average over 100 years, 7%. So if you get anything above that, you've got above average, you've got a move that is above the annual average for the S&P over the past 100 years, all happening in a month. So when you get 1 month that moves more than the average of an entire year, you're at such an outlier that investor professionals and investors begin to change their behavior. What happens? Well, first off, people run and buy more. This is a very bullish signal. If you get 7% in a month, you have a higher percentage chance that the rest of the year is going to be better than, or at least the next few months, I should say, not the whole year. But for the next 3 and 6 months, you get better than average performance through that period of time. And so, and when I say better than average, I'm talking about more than 7% for a month. You get the big jump, and then it gets less and less, but it's still more than an average month for the next 2 or 3. But the kicker is that if you go more than 7%, if you go forward 270 days, 56 weeks, then that 20-day period that follows from that one going forward is lower than average. In fact, it's one of the few periods in all this, thing that on average is negative. And depending on how you measure it, and with dividends or not, that thing may not come out negative. It might come out, close to break even or slightly positive. But compared to its average, it's lower. It is significantly lower. So for the 4 to 8 week period that occurs after the 56-week run up, after the 7% month or 7% or better month, then that is a period unusually marked by selling. And so what I did is I drew on this chart a bunch of these little lines, and each one of these lines represents a period where we just got done with 20 days of strong selling, and then you go forward 272 bars or so, and what happens? And there in 2011 was a big drop. There in 2012, later on in 2012, another one. But each one of these comes right at the end of these arrows. Now there's, these time frames. And the time frames are, a month that had, well, not all of these are 7%. Some of these are like 4 or 5%, the ones that are kind of weaker, right? But you get the idea. Now, let's come to the most recent version of this. Okay, where are we now, right? If you accept my premise that in fact you could go back and you could check the data and see for yourself that there is this pattern, if the market runs up so much, runs up more than 7% in a month, then you have a collection of buyers that are all doing what the professors taught them to do. Hold on for the month because the tax incentives give you, in fact, the incentive to do that, and then only then sell. Then you have this, extra push of people that want to sell at this later period of time. If in fact that's true, shouldn't we see evidence of it? Well, we did. We did very recently as the beginning of the pandemic. So if you go back to before the pandemic, a year before, there is this move that at the end of 2019, it was almost, well, it was slightly more than a 20% drawdown. And then all of a sudden, the markets took off and went back up. What caused that 20% drawdown? I believe that had to do with the number of people turning 70 or older in the United States who had a required minimum distribution. They had to pull out 3% of their 401ks by the end of the year. And so notice that happened all right at the end of the year. And then just in that last week, starting literally at day after Christmas, the market started going up. Well, if you counted from that low on December 26th and going forward 20 bars, this shows that it was 8%, but actually that's not correct because it's not all the way up. It's even a little higher than that. It was about a 14% move. So on that month coming out of 2019, the markets increased by 14%, largely from a rebound from the 2019 selling. But whatever the reason was, whatever it was, why it sold is unimportant. It was significant big down and a significant move back up. So there's a lot of buying. I remember that time because I was day trading through that period of time, and I had a great month. I made 20%, over 20% in that first month coming up out of that, because I was able to anticipate that bottom was going to be right around there. And the very day after that move up, I started going aggressively long because, I knew about the required minimum distribution thing. So what happened then is when that ticked off and I had such a good month, that I looked back and thought, wait a second, is this a new 56-week clock getting started here? And I didn't know at the time, but the answer was, yeah, it was probably one of the more significant 56-week patterns that was about to occur. Because starting on that day right there, which is the 24th of January, there was nothing significant about that day in the markets. It just was the ending of a period of time where a whole bunch of people had bought in, and they had started their 1 year clock, right? Going forward from that. Now, why wouldn't it be 52 weeks? The answer is that you got to have this 1 month on the beginning, and you need a month on the end of sort of, to kind of see, it's not just on this day and then they immediately start selling, right? They start watching. It's 1 day, 1 year goes by, and then they say, okay, now I'm ready to take profit. Now I'm tempted to take profit. I mean, I'd soon let it go. If the market's going to keep going, I'll let it go. I'm not going to, start selling. That's what people do. But if all of a sudden the market starts coming down, right, early on, if you buy and the market goes against you, what do? Oh, fluctuation. I'm going to hold. I'm not going to make a profit I'm not going to make a loss until I sell. So I'll hold on, right? That sort of attitude of, well, I know it went against me, but I like the stock. I love the idea, whatever. You hold. And but if after a year you've had a really successful move and the market starts going against you, now what do? Do you still have that same degree? Well, some people do, and good for them. But most people start to fidget. After a year, they're into that lower tax circumstance. So they're thinking, I could take profit now. I could take profit. I've got good profit. I don't want to lose it. I don't want to lose it. And all of a sudden the market starts coming down. Fine, I'm going to take it. Put my stop losses. I'm going to trail my stop losses, whatever, right? That behavior wouldn't matter in one investor. But if you have a collective mass, a critical mass of people that, were built up over a 1 month period of time, and then the first of them starts getting tempted, and the second and third, more and more and more. Now you've got a critical mass of people all being tempted, all having set their stop losses and so forth. That is when the fuse is lit. That's when any bad news, even the slightest little bit of bad news, now begins to have impact. Well, what happened here on the 24th of January was that we started seeing a year later, on the 24th of January, COVID headlines were already going all through the month of January. Why didn't we have this big crash back there? The answer was that not all of these people who bought in had hit their 1 year timer. And of those that had hit their timer, not all of them had really kind of got to a point where they were panicky enough to do something about it, or itchy enough to do something about it. But this timer, this 270 bar timer, really does a good job of sort of telling you, all right, now is the point where we've kind of hit that critical mass. And sure enough, if you look on that day, the 19th of February, that was the day before the selling happened. The selling started to happen. We had these headlines going off, and when Italy finally started, their numbers started rising, and the headlines started coming out about how the healthcare system in Italy was overwhelmed, and patients were dying in the hospital halls of COVID. And I'm sorry, I don't mean to sound like I'm making light of that. I'm not. When those dire headlines started getting published, that's when people really started to get panicky, and that's when all this selling really took place. But the VIX was already pricing in a massive divergence. There was a lot higher VIX pricing going on for a whole month before the selling hit. So that tells me that the headlines were already having an effect, but people weren't pulling the trigger. Why? My hypothesis is that not enough of them had hit the 52-week, the 1 year tax break mark from back when they bought. But once they did, then the ball really got going. All right, well, look, if that's the case, if that's the truth, then where are we now? Because look what happened right after that, right? Even more buying. In fact, this buying that occurred, let me just move these forward here. We go from the bottom of that day. Yeah, we'll do it. We'll do it the extreme, from the bottom and then 20 days forward. There we go. And I don't know, I might have started that in my other counts on the next day after. But as you can see, look at that. That was a 30% move. Yeah, as I did start from like there. 30% move from the ultimate low. Do you get the ultimate low? No, nobody ever does. But that's a massive move. 1 month of trading coming up out of the bottoms of the COVID lows was, depending on how you measure, around 30% gains. Does that represent a lot of money flowing in? You bet it does. And then we start the clock ticking, right? This in fact is probably the highest single 30-day period on record, going back in any period of time. At least in the data that I saw, I think that's probably bigger. And what do we have since then, right? Look at what's happened in the markets so far since then. And we're up 46% after the 30% move. Okay. Well, actually, I guess I'm not starting it right from the top there. I'll because the markets kind of came back. But let's do that. Let's go from the top of that 30% move. What has happened? 38, almost 40% move. And we just broke through new highs yesterday, kept continuing to go through. So where does this go? Where does this, well, that's what I've been telling you about. May 14th, there it is. See, now that's 269 bars this time around. I'm going on the early because what I've noticed is that this thing will go anywhere from in hindsight, it goes anywhere from 269 to 272. So I'm giving you the earliest possible day. 269 bars is May 14th. It could come earlier. Most of the time it doesn't. It could come later. But if you're prepared for May 14th, you're ready, right? Now, what are we going to see leading up to that? We might see this straight up cliff drop like happened last time around with COVID, but that's rare. It doesn't usually happen, this hard cutoff. What more often happens is that as you approach the top, you see this sort of weakness and prices start to kind of deteriorate a little bit, and then a big move will come because some news will happen. In 2010, it was Greece and all of that stuff got started right about the time of the flash crash. So some people said, "What's the news?" Right? People react people get in their minds that they want to do something. They either want to buy or they want to sell. They make the decision and then they go looking for excuses to do it. That's how investors behave. Like it or not, that's the best model I've found for explaining how things go. They have this idea in their minds. Why? Because people don't react to the news the same way. Sometimes you get this horrific news company wise, and the prices barely drop. Other times you get this slightly bad news, which really isn't all that bad. And you'd think that the CEO just committed one of the greatest crimes of the century or something. It was just a horrible drop in prices, right? So people's reactions, investors' reactions to bad news varies wildly. What is bad news one day won't be bad news another day. And same thing happens in the currency markets. It's like, why are people overreacting? Or it's not like you can get a headline that you can mechanically say, oh, well, that's a -4% move. I know because I have this metric. No, throw out all those metrics. None of them work. And so what happens is you say to yourself, is there something that makes people want to sell? Had they already decided to sell? So my hypothesis is, because they bought a year ago, they're tempted to sell. They're not for sure going to sell, they're tempted to sell. And when you get a collection of people that are all tempted to sell at the same time, that's when you have dangerous circumstances in the markets. Then if a headline runs across the ticker that scares people, well, those people were already scared. They were already nervous. And then what they did was say, okay, let's sell. And so those are the periods of time where you can get rapid moves. That's the period of time when a broker gets a whole collection of orders coming from everywhere, and they got to walk onto the trading floor nowadays, electronic, and get people out. Not because they think it's a good idea, but because their customers are saying, do that. So, okay, got another chat here. Let me have a look. Wow, this training is great. Couldn't agree more about the news. Thanks, Roy. Okay, so this is Roy coming back saying, I take it, Roy, this is answering your questions, right? I don't have time to get into it today, but I have applied this same methodology to individual sectors of the market and notice that there are varying patterns, and even so much as to get down to individual stocks. I hope sometime within the next 6 weeks to be able to show some of that individual stock research. But until we get there, until that day comes, what I want to do for you right now is share with you a watch list that I have built specifically to be prepared for this 56-week selling period. And this is my short list, so to speak. This is the list of stocks that I plan to prepare to short come May 14th or slightly before, depending, right? Now, how did I develop this list? It's a lot simpler than you might think. First off, it's just general weakness. But second, what I did is I went back to a website called Whale Wisdom. All right. I'm just trying to show it to you here. I really, I'm not a subscriber. I don't get anything. And Actions 12 doesn't get any bump if you go subscribe. I'm not even recommending that you do. I'm telling you about it just so you know where I got my information from. But what this is hedge fund tracking. And so hedge funds are required to file a report called a 13F. And so a 13F is basically, here's all the stuff we had to trade or that we traded. And here's all the positions we have. It's like, if you think about it, you're like, really? A hedge fund has to tell everybody what they're doing? Yeah, sort of. They report for a year period, and then they have a quarter, a whole 90 days to get this thing filed. So guess what happens? They don't turn it in until it's 90 days old or 3 months old or whatever, right? As an example, the period of report was 3/31/21 in that top one. And the date that the data was imported into the system is 4/05, and the number of stocks in the filing 217. But if you go and you look at it, you'll find that it goes well, actually, this one does go. See the one right before is 1231 Stockbridge Partners, and then here's this. Yeah, 1231. So it's end of year 2020. This one actually happened in 2021, and so they are silly enough to actually report this just 1 week after they were done. But most of this action happened the year previous. So this is their sector allocation, and how they changed their sectors and what they were putting their money into over the past year, or um, years, I should say, 2009, 2017. So this is quarter by quarter. So what did they do just in the last 4 quarters? See these green bars getting bigger? This means this company was putting more money into finance. All right. And so that was one of the places. I went and I looked through a bunch of these. And so where are the hedge funds? Where did all of their money go into? And big surprise of the past year, most of them went into technology. So guess what came out over the past 3 months? Technology. That's why technology has been having such a bad go of it, because most of all these big positions that went in had a lot of profit, and they were simply taking their profits. But what else? Clean energy. And so a lot of these stocks have to do with the intersection between technology and clean energy. So we're going to be talking more about these as they come along, because these stocks are still vulnerable to that move. Yeah. So why did I look at hedge funds? Hedge funds have that tax thing going on. They have to pay taxes over the long-term capital gains versus ordinary tax income, and they're full of wealthy individuals who themselves, accredited investors, have $1 million or more, that sort of thing. They have tax implications. So hedge funds are really going to be drivers of this dynamic. And so, yeah, if you understand what I've been telling you these past 45 minutes, you realize this isn't going away. It's still out there. And it started a year ago, and the time bomb is ticking, and it's going to have an effect. People are still going to try to manage their taxes, right? So if I look at these various symbols, let's see if I can look at so much more to tell you here. In the book that I co-authored with Tony Turner and published several years ago, I also came up with this method, the stop-go method. I'm going to have to save that for another period of time. And then the sector method as well. This one I can tell you really quick. I just compare the consumer staples sectors. These are the defensive stocks: Walmart, Walgreens, people that sell toothbrush and toilet paper. Okay. When the recession hits, when a recession hits, people still have to buy those things. And so investors tend to put their money into consumer staples when they're afraid of things, right? They also tend to put their money in utilities. So that's the other chart. It takes a little more time to explain. This one, however, is very simple. I compare utilities to discretionary. So I look at the two sectors, XLP and XLY, and I just compare them and say, how are they trading? Well, XLP and XLY compared, that's that purple line right there. They were going down until about mid-February, and since then, XLP has been doing better than XLY. So XLP is the red line, XLY is the blue line. See how the blue line is getting ahead of the green line, and then all of a sudden they start kind of converging together. Now, just in the past couple of days, they've started widening again. Maybe that's going to widen out and stay that way. But my guess is that you're going to see this over the next 6 weeks. You're going to see it tighten and tighten, because there are enough hedge fund guys out there that know the market is getting less and less strong. And so they're going to put less and less money into XLY, and they're going to, start hedging their bets. So they do. They're a hedge fund. They're going to start protecting against downward moves in the market. And so they're going to slide a little more money over to consumer staples. This has already begun. See, there in March, and the purple line is the relative difference between the two of them. So that purple line increasing still tells us that the large investors are getting more and more nervous and hedging their bets more. The effect is even more profound in the utilities, which has a 100-year, 90% track record of calling major tops. And we've got a lot of evidence suggesting that people are getting nervous. I think that nervousness is going to increase between now and May 14th. Will there be a cliff dive? I hope so. I hope that what we see is this kind of nice move up, and then all of a sudden, boom, right? Because if I'm on the short side, I'm either shorting stocks or I'm doing put options on stocks. So what I'm going to be doing over the next 6 weeks is featuring this short list. Let me go back to where that is. This short list. Run is a solar company. See, they've already had this huge move and this big sell-off, right? And so you look at that and you think, oh, well, Gordon, couldn't you have told me to sell short right here and capture this move? Yeah, I don't have that kind of predictive methodology. But what about a 50% drop from here, from 60 down to 30? Do you see how easy that would be for a stock like this? Big move down, consolidation, another big move down. That's just a bear flag pattern, right? How about Hznp? This one's kind of fun because we don't have that big move down. We could get a cliff dive out of this thing at some point. And when would we get it? Check that out. 12th of May is earnings, right? You got a bunch of nervous people, and these earnings come out slightly less than favorable, right? These are the opportunities I'm looking for. I know I'm not going to be able to find everyone, but some of the best, right? Plug that had this bad move down, but it could have more. Tesla, I'm gonna walk you through this piece by piece, and you're going to see that Tesla's gonna have a lot of room to fall if what I say happens is going to happen. And on down the list, we will be looking at each of these. Now, if you can't go short, is there a way that you could just, if you can do long only, is there a way you could profit? Absolutely. I've got 3 stocks right here: SQQQ, TZA, and SPSX. Are all leveraged inverse funds, which normally are terrible trades. You wouldn't want to take them. But for that 1 month period of time after May 14th, or shortly before and then going forward, they could be really fantastic plays. I saved that trading in these things almost exclusively for these post 56-week periods. Here's another one, SRTY. It's the ultra short Russell 2000. So it's kind of like TZA. And then there's the semiconductor. This is short the semiconductor sector or industry, short the technology, and short China. None of these look good now. They all look terrible now. But when May 14th rolls around, I got to tell you, they're going to look fantastic. And they're just simple. You buy the stock, you wait a month, and should be a good move, should be a good profit. So that's what's coming up in the upcoming future. That was the long version. I will not go through this again through these charts and chat sessions. So you were here, lucky you got to hear the full explanation. It'll be on YouTube, and I'll be giving out links so people can go through this long form explanation of how this happens. And so what do you do during that period of time? Well, what you do is you look for this list. You look for these people that went short and that have vulnerabilities, and either you short them or you do put options, or if you can't do that, then you just do the inverse ETFs, which allow you to take advantage of down moves in the indexes. Now, one final thing to say about this. When this goes down, does it just go down forever? No. It starts with a 4-week period, because it took 4 weeks to get into this. You get about 4 weeks of selling as people kind of jockey their positions and figure out what they want to do. And if after 4 weeks the markets find a base and start heading up, the fact that it was only 4 weeks is a major indicator that the next 52 weeks are going to be a strong upward bullish move. So if you get all this selling and it doesn't have much impact, that tells you that people really want to buy and hold some more. So you should too. If in fact it lasts 8 weeks, that's less strong. If it lasts longer than 8 weeks, if the selling comes in and lasts longer than 8 weeks, we could be in for a bear market, as in 6 to 9 months of serious selling. More than 20% drop would occur. And that is what you want to watch out for. There are good reasons why that might occur this time around. All through the summer, we could see selling and we could see a major bear market happen. Now, I think that there's 50-50 reasons why it may or may not happen. And I want to discuss those in the weeks that come. But what I'm trying to tell you is that what you do with this information I gave you is prepare to profit from a 4-week drop. Watch to see if it's going to be an 8-week drop. And if somehow after 8 weeks it looks like it's a little buoyant, get ready to be a buyer, because those are some of the best times to jump in and be buyers. We're going to keep you prepared for the top turn and to recognize that bottom turn. So like me, you can have a 20% month or better just by anticipating that. And so, all right, until next time, everybody, I hope that you ponder on this and that you're able to trade profitably